What's up, traders? Facebook can't possibly go lower. At least that's what everyone was saying on February 3rd, 2022, on this big move down on earnings. Well, in this video, I want to talk about the meta contrarian narrative. Yes, pun intended. Look at the price action of Facebook, see why it didn't stop and where it may be going. And then finally, I'm going to look at option strategies that would have been a good way to express the trade using the current market conditions. So, the first thing I want to address is what really clued me in to start saying that as a meme. On February 3rd, the day that earnings came out, I checked my phone at noon and I saw I had three messages from personal friends asking me if I was buying Facebook. Seems like a buy, right? It's at a discount, it's cheap. Looked at some discords that I was subscribed to, and the market sentiment was pretty similar. People were expecting a quick bounce. It's bound to go back up. But that got my contrarian senses tingling. And I remembered an adage from one of my favorite investors, Peter Lynch, which is a stock can always go lower. But everyone thought that it couldn't. Well, let's take a quick look at the price action. So let's go back to the day before earnings. And we're going to look at the weekly to really encapsulate the entire move. Now, if you watch a lot of my content, all 12 of you, then you'll know that from the bottom to the top of a major trend is where I like to draw a 50% retracement. And like many stocks, now and for many years in the future, where we start this trend is going to be the COVID low back in March of 2020. Then it's very easy for us to go up to the all-time high. And that creates a 50% retracement at $260 a share. I like this level because it's also a place where price found support before launching into another leg back in the beginning of 2021. And so when we had earnings, 260 was a level I was looking at. The problem is it opened below that level I had marked off as support. It's dangerous. I'm staying away from that. But then I started reading this narrative, this market sentiment that everyone was thinking we're going to have a quick bounce. And who is wrong to think that? Facebook is a well recognized company, it's a mega cap stock. It's hard to believe that a stock that was down over 20%, almost $260 billion, I think, of market cap, just wiped out in a single day. That's bound to bounce back, isn't it? Well, I think in the days that follow, we're seeing that people are getting a lesson in that narrative that a stock can always go lower. So, how does someone express this trade? Well, I'll admit I'm afraid to short shares on a mega cap stock like Facebook. That doesn't jive well with me. So, what a lot of people do is they want to express that kind of a trade with options. And so, let's look at options in that case. The first thing we want to really evaluate, though, is implied volatility before we look at options. Now, a little brief refresher on what implied volatility is. Imagine IV, implied volatility, is the tide of the ocean that rises and falls. And on that ocean are every single call and put. And so going into earnings, implied volatility rises typically, and that lifts the value of all calls and puts. And then typically on earnings, IV falls because the uncertainty has been removed. And every option, put, and call loses value. They call it IV crush. And it's not good if you're long single options because even if you're right, you're still losing money on implied volatility. Facebook, on the other hand, did something a little unique. Because it had such a violent move, the implied volatility actually jumped up to the highest it's been in over a year. Intraday, I remember looking at this, and the IV rank and percentile were 100%, highest has been in a year. Now you're starting to see a slight decrease in implied volatility, but it's still pretty elevated. So buying single options, or in this case, single puts, you would have made some money, but that doesn't mean that strategy is going to work best in every situation. When you have high implied volatility, you might want to get a little more creative. We're going to talk about that in just a second. Let's first look at the option chain. And for that, I'm using another tool from Thinkorswim called ThinkBack. It's good for options back testing. By the way, I don't get paid anything to say these things. It's just a tool that every trader should have, just like TradingView. So here is the option chain for March, which seemed to be the common option expiration people were trying to take. Well, I'm sure people were trying to take the February's, but yeah, that's not doing too well for them. So the 250 March call seemed to be what most people were talking about on social media. And the opposite side of that trade was the 225 put. Both are roughly the same. 1022 for the call, 975 for the put. And then if we go to today, we can see what happened. Well, the call has pretty much evaporated. It's down 965. The put is up $1,200, which is good. That's some solid money. But let's be honest. If we're buying single options, out of the money options, we're going to lose more than we're going to win. It's just the way the statistics are stacked against you. Most out of the money options expire worthless. It's just a wind at your front, keeping you from making money. So we have to make sure that we make more than we win. And in this case, let's do the math. So we made 1270. See, I've already done it once. 1207, and it cost us a risk of 275 to make that happen. Okay, so what we need to do is 1207 divided by 75, and that gives us a 123% return on risk, return on capital, however you want to look at it. It's fair. That helps. That's good. But let's look at it a different way, especially something that fits with the implied volatility that we had. What I like to do is a put debit spread. How we're going to do that, don't be confused by the name. I know it's a mouthful, but we're going to start that by buying the put that we wanted, the 225, and then we're going to sell an option further out of the money against it. I'm going to do the 215. It's going to do a couple of things. Number one, it's going to get our cost down. Instead of paying 975, we're going to only pay 305 because we had to buy the 225 for 975, and then if we sell, we receive a credit, the 215, we get about 675 off. So we get it cheaper because we're selling against it. The other thing it does is because they both are experiencing the same effects of implied volatility. As implied volatility moves one, it moves the other in the opposite direction. So implied volatility pretty much offsets. And so we have a nice, clean, less influenced by IV trade for less money. So let's go up and see what happens. Well, our profit is 405 on our 305 risk. So 405 divided by 305, that is a 132% return on risk. So we're actually getting a better reward to risk than just buying the individual put. Now, time's going to factor into this, but as it stands right now, we're doing pretty good. We need it to stay below 215 to get the full value. And in that case, since we paid 305 for it, it's a $10 wide vertical spread. That means the max that this could be worth is 10. Subtract 3. We could make potentially about $695 on that, which would be close to a 2 to 1. And I like that. I like that a lot. The reason I wanted to make this video is because this was a teachable moment in really helping people internalize that thesis that a stock can always go lower. And it also pays to pay attention to market sentiment, what people are saying, but not necessarily do what they're saying. The market, as I'm sure you may feel, tries to hurt the most amount of people it can. And right now, that's what you see. Facebook is just grinding down all those people that wanted to buy into this. Where is it going? Well, honestly, I think that the best solution for situations like this is prevention. And that's why I talked about how it came to a level I liked, opened below it, and I didn't like it anymore. Now, you may like the company. You may be excited to put on the VR headsets and live in Mark Zuckerberg world in the future. That's fine. I'm not going to discount that. But you're getting down into a range here that is breaking the 2018 and 2019 all-time highs. It's a dangerous zone here. I don't know where it's going to turn around, technically. Your guess is as good as mine. If you're a long-term investor, okay, I hope it works well for you. But I want you to learn from this experience. And in the future, trade wisely. We'll see you in the next video.